Hello students and welcome back to another new chapter from Accountancy. Our today's lesson is on accounting for partnership, basic concepts. I'm sure all of you have gone through our lesson videos on the chapter Forms of Business Organization from Business Studies. The third and fourth part of the lesson videos talk about partnership form of business. We spoke extensively about the audit firm across the chalk, Peter and Sidney LLP. Sole proprietorships are concerns where the capital is only from one source. But a need for increased capital along with additional manpower and similar other dimensions call for additional heads for propriety. So, here comes the concept of partnership form of business. Partnership is defined by the Indian Partnership Act 1932 as the relation between persons who have agreed to share the profit of the business carried on by all or any one of them acting for all. 1. Formation. A partnership business is regulated by the Indian Partnership Act 1932. A partnership deed, which is a legal document, forms this particular form of business and defines many things including the profit or loss sharing ratio of the partners. 2. Liability. Partners here have unlimited liability. However, it's a unique feature of this form of business where partners are jointly as well as individually liable for the payment of business debts. Any partner individually is liable to meet business debt at any point of time, notwithstanding the fact that such payment can be later recovered from other partners proportionate to their respective liability. 3. Risk-bearing. The risk-bearing reflects in running the business as a team. However, rewards are apportioned as per agreement signed at the inception and so are losses. 4. Decision-making and control. Decision-making and control happens as per mutual consent within the partners. 5. Number of partners. The minimum number of members for a partnership business is 2. Wide Rule 10 of the company's Miscellaneous Rules 2014, the maximum number of members can be 50. 6. Continuity. Business continuity is often a challenge as the death, insanity, retirement, or insolvency can hard stop the involvement of any partner. However, the remaining partners may try and continue with a fresh agreement. But in any such case, the business definitely gets a hit. 7. Mutual agency. The definition of partnership emphasizes the fact that the business is carried on by all partners or any one partner acting for all. So any partner acts as a principal as well as an agent. Now we will learn about another important term, that is the limited liability partnership. An incorporated partnership formed and registered under the Limited Liability Partnership Act 2008 is termed as the LLP or the Limited Liability Partnership. The main features are limited liability and perpetual succession. LLPs are viewed as an extremely flexible model of business vehicle which bakes in the benefits of limited liability and also for the partner's convenience to play around with the internal structure. Now, there are a few salient features of limited liability partnership which we will quickly run through. LLPs are unique from its partners and has a separate corporate and legal identity. The mandatory requirement is to have minimum 2 partners and minimum 2 designated partners of whom at least one shall be resident of India. LLPs are exempted from the Indian Partnership Act 1932. Perpetual succession is the core essence of any LLP. The central government has the right to investigate the audit of a LLP. Going back to my school days, when Dad used to visit Peter and Sidney, I found out something very interesting one day. And guess what? A partnership deed. You just heard the word partnership deed, right? Yes, this is the incorporation prerequisite of any partnership business. Dad explained me with all his patience. It generally includes the name of the firm, the business duration, the location and nature of business, distribution ratio of profits and losses, capital contribution of individual partners, primary duties and obligation of the individual partners, salaries and withdrawals of the partners, admission, retirement and expulsion terms of partners, interest percentage on capital and drawings, accounts preparation and their auditing, dispute resolution, terms to the dissolution of the firm. As a kid, I used to be really inquisitive about Peter and Siddy and everything about the firm. In fact, Dad's lesson helped me a lot during my higher studies in accountancy. The partnership accounts are mostly dependent on the number of provisions. Dad made me understand the most important ones in details. The profit sharing ratio. The profit sharing ratio, if not specified explicitly, has to be equal for both the partners, meaning profit or loss has to be shared equally between all the partners, ignoring the capital contribution of the respective partners. Interest on capital. Capital contribution by partners comes at 0% interest rate, meaning the partners are not entitled to any interest on capital contribution by them. However, if explicitly agreed by the partners, also interest remains payable only if the partnership has profit. In case of loss, interest on capital is not payable. Interest on drawings. Similarly, drawings by the partners are without any interest. However, if explicitly mentioned in the deed, then they become chargeable. Interest on advances. In case of liquidity crunch or any other circumstance, partners may have to advance money to the firm. Such advances are beyond capital and are chargeable at a rate of 6% generally. Remuneration for firm's work. Remuneration is payable on firm's work to partners only if it is mentioned in the partnership deed. The Act also specifies that subject to the contract amongst the partners, if any partner draws any profit from any transaction pertaining to the firm or use of firm name or business connection of the firm, such profit should be accounted for and paid off to the firm. Peter, the active partner in Peter and Siddy partnership firm, used to be a wonderful artist. During the lean audit period, Peter often held art exhibitions in the office space. Whatever would have been the profits of the show were accounted for and a portion paid to the firm, Peter and Siddy. And why so? Because the profit earned was also a function of the office space usage. So the calculated amount, as mutually agreed, had to be paid to the firm. Also, if a partner executes any parallel business of the same nature as the firm and in competition with the firm, such profits shall have to be accounted for and paid to the firm. Now, when we come to the detailing of partnership accounting, there are a few exceptional treatments, namely maintenance of partners' capital accounts, distribution of profit and loss between the partners, adjustment for incorrect appropriations of profits in the past, dissolution of partnership firm, reconstitution of the partnership firm. We will learn about all these in the next parts and series of our lesson videos. Till then, happy learning!